The CME just raised margin requirements on silver. Again, silver is up over 7%. Momentum is screaming higher. And right when traders start feeling confident, the exchange walks in and says, you need to post more cash, right now. Most people will ignore this. They'll keep watching price. But if you understand what margin hikes actually do to a market, you'll understand why this might be the most important signal in silver right now. More important than the dollar, more important than yields, more important than the chart. Let me explain. Welcome back. I'm James. Today is February 14th, 2026. And if this is your first time here, this channel breaks down precious metals using structure, positioning, and market plumbing. Not hype, not price predictions, the mechanics that actually move markets. If that's valuable to you, subscribe. It's free, and it directly helps this channel reach more serious investors and traders. Drop a comment telling me where you're watching from, and tell me this right now. Has a margin hike ever forced you out of a trade? Yes or no? Be honest. Because if it has, today's video might be the most important one you watch this year. And if it hasn't, you need to understand how it works before it happens to you. Let's get into it. Silver is in a state of controlled chaos right now. And I don't use that phrase for drama. I use it because it's mechanically accurate. On one side, you have powerful upside momentum. Silver futures recently printed near $94.77, reflecting a gain of roughly 7.53%. That's not a quiet grind. That's an aggressive, fast, momentum-driven rally. The kind that attracts attention, attracts new money, and attracts leverage. On the other side, you have the CME group actively tightening the rules of engagement, raising margin requirements, increasing the cost of being in this market, making it harder and more expensive for leveraged traders to hold their positions. And then you have the macro cross-current. The dollar is soft near 96.90, which is structurally supportive for metals. But the 10-year Treasury yield is sitting at 4.18% as of February 11th, which is still elevated and still represents a meaningful opportunity cost for holding non-yielding assets like silver. So you've got momentum pushing up, the exchange pushing back, and macro sending mixed signals. That's the crossroads. And how it resolves will depend on one thing that almost nobody is talking about: the plumbing. Here's the first cliffhanger. What exactly happens inside the clearing system when CME raises margins? And why can a single administrative decision by the exchange trigger more selling than any economic report, any Fed speech, or any geopolitical event? I'm going to explain this in plain language, step by step. Because once you understand this mechanism, you will never look at a silver rally the same way again. Let's start from the ground up. When you trade silver futures on COMEX, you are entering a contract. That contract represents 5,000 troy ounces of silver. At current prices near $95, a single contract controls roughly $475,000 worth of metal. But you don't pay $475,000 to enter the trade. That would be buying silver outright. Instead, you post margin. Margin is a performance bond. It's collateral. It's the exchange's way of ensuring that you can cover your obligations if the trade moves against you. Think of it like a security deposit on an apartment. You don't pay the full value of the apartment, you put down a deposit, and if you damage the apartment, the landlord uses that deposit to cover repairs. If the damage exceeds the deposit, you owe more. Futures margin works the same way. You post initial margin to enter the trade, and every single day your position is marked to market. That means the exchange calculates whether you made money or lost money that day. If you lost money, the loss is deducted from your margin balance. If your margin balance falls below a certain threshold called the maintenance margin, you get a margin call. A margin call is not a suggestion. It is a demand. Your broker tells you to deposit additional funds immediately, typically by the next business day. If you don't, or if you can't, your broker liquidates your position. They sell you out, at whatever price the market offers at that moment. And here's the critical part. You don't get to choose when or how you exit. The broker exits for you, in real time, at market price, which during a liquidation cascade is usually a terrible price. Now here's what makes CME margin hikes so powerful. The exchange doesn't just set initial margin once and leave it alone. They actively adjust it based on market conditions. Specifically, they adjust it based on volatility. When silver gets more volatile, the CME raises margin requirements. The logic is straightforward. Higher volatility means larger daily price swings. Larger swings mean greater risk that traders can't cover their losses. Greater risk means the clearinghouse needs more collateral to protect the system. So the CME raises margins. And when they do, something mechanical happens. Every single trader who is currently holding a silver futures position suddenly needs more capital posted. Not because they did anything wrong, not because they lost money, simply because the rules changed. The exchange moved the goalposts. For well-capitalized traders, this is an inconvenience. They post the additional margin and move on. But for leveraged traders, traders who entered the market with minimal excess capital, this is a crisis. They were already near their limits. And now the exchange is demanding more. They either need to wire in additional funds immediately, or their broker will begin liquidating their positions. And this is where the cascade begins. When multiple leveraged traders face margin calls simultaneously, they all need to sell at the same time. Not because they want to, because they have to. That concentrated forced selling pushes price down. And as price drops, other traders who were borderline on their margin now also get triggered. They also become forced sellers, which pushes price lower, which triggers more margin calls, which creates more forced selling. This is a liquidation cascade. And it is the single most dangerous mechanical event in futures markets, not because of fundamentals, not because of macro, because of leverage meeting tightening conditions. And this is exactly the environment we're in right now with silver. Let me connect this to the current setup. Silver has rallied aggressively, up over 7% recently. That rally attracted speculative capital. Traders saw momentum, they jumped in, many of them with leverage. At the same time, the CME has been raising margin requirements. Each hike raises the cost of holding a position. Each hike reduces the buffer between current margin levels and the maintenance threshold where margin calls trigger. So right now you have a market where a large number of speculative longs entered during a momentum rally and are sitting on positions with reduced margin buffers because the exchange has tightened requirements. That's the fragility. That's the structural risk. And it exists regardless of what the dollar does, regardless of what yields do, regardless of what any analyst says about the long-term outlook. If silver dips, even by a few percent, the margin math can turn against those traders instantly. And if enough of them get liquidated simultaneously, you get a flash crash. The kind of sharp, violent downdraft that makes people say, "What just happened? I didn't even have time to react." Now here's the second cliffhanger. If margin mechanics create this much fragility, why is silver still near $95? Why hasn't the flush happened yet? And is there a force underneath the market that's actually absorbing the risk and preventing the cascade? The answer has two parts, and both of them matter. The first part is the dollar. The DXY is trading near 96.90. That's a soft dollar. Not collapsing, but consistently weak. And a weak dollar is one of the most reliable tailwinds for precious metals. It reduces the cost for international buyers. It signals looser financial conditions. It makes dollar-denominated assets like silver more attractive to global capital. If the dollar were strengthening right now, if the DXY were pushing above 98 or 99, the margin fragility would already be triggering. A rising dollar would pressure metals, create losses on long positions, and push leveraged traders into margin call territory. But the dollar is soft, and that softness is acting like a cushion underneath silver. It's absorbing some of the downward pressure that would otherwise activate the margin cascade. The second part is physical demand. Let me share a number with you. PSLV, the Sprott Physical Silver Trust, reported holdings of 216,931,156 ounces as of February 6, 2026. That's nearly 217 million ounces of real physical silver sitting in vaults, not paper, not derivatives, actual metal. That number has been growing, and it tells us something important. While the futures market is volatile, while leveraged traders are getting squeezed and margin calls are triggering, there is a parallel flow of capital that is steadily accumulating physical metal. This physical bid doesn't show up on a futures chart. It doesn't respond to margin hikes. It doesn't get margin calls. It just accumulates, quietly, persistently, and it creates a structural floor under the market that paper selling struggles to break through permanently. This is the tension at the heart of silver right now. Paper fragility above, physical strength below, leverage risk on one side, accumulation on the other. And the question is, which force proves dominant in the near term? Now let me layer in the remaining macro context because it matters for the scenarios. The 10-year Treasury yield sits at 4.18% as of February 11th. That's still elevated. It's not as high as the 4.50 or 4.60 levels we saw at various points over the past couple years, but it's high enough to matter. For silver, elevated yields represent a persistent headwind. Every day that yields stay above 4%, investors face a genuine alternative. A risk-free 4.18% return from treasuries versus zero yield from silver. That math matters, especially for institutional allocators who measure opportunity cost precisely. But again, direction matters more than level, and yields have been softening from their highs. They're not collapsing, but they're easing. And if that easing continues, if economic data cools, if the labor market shows signs of softening, yields could move lower, and that would reduce the opportunity cost argument against silver. So the macro picture is a cross-current: dollar soft, which helps silver; yields elevated, which hurts silver. Neither force is dominant enough to resolve the tension cleanly, which means the margin mechanics become even more important as the deciding factor for short-term direction. Now let's talk about positioning. The most recent COT reference shows a familiar structure. Commercial traders, your miners and hedgers, maintain dominant short positioning. Manage money, your hedge funds and speculators, maintain net long positioning. This is the typical configuration you see during silver rallies. Producers sell forward into strength. Speculators buy momentum. But the key metric right now isn't the composition of the positioning, it's the open interest. At approximately 143,180 contracts, participation is active but not extreme. We've seen higher open interest levels during previous speculative surges. This is actually important context. It means the current rally, while aggressive in price terms, has not attracted the kind of extreme speculative pile-on that preceded previous crashes. Positioning is directional, but not as crowded as it could be. That doesn't eliminate the margin risk, but it moderates it. A market with 143,000 contracts of open interest is less fragile than a market with 170,000 or 180,000 contracts of open interest, all else being equal. So where does that leave us? Let me lay out two clear scenarios. One constructive, one dangerous, and I'll tell you exactly what signals would confirm each. Scenario A is the controlled advance. The margin shock is absorbed and silver continues higher. This scenario gains credibility if the following conditions hold. First, silver absorbs the margin hike without a significant pullback. If price holds above recent consolidation levels, above yesterday's lows, above weekly closes, it means the market has enough well-capitalized longs to absorb the additional margin requirements. The weak hands have already been cleaned out, and the remaining participants can afford the higher costs. Second, the dollar continues to soften. A DXY moving below 96 and toward 95 would provide a meaningful tailwind that could overpower the margin headwind. International demand would increase. Dollar-denominated silver would become more accessible globally. Third, yields continue their gradual decline. Below 4.10% on the 10-year would signal that the macro environment is shifting in silver's favor. The opportunity cost argument weakens. Capital becomes more willing to hold non-yielding assets. Fourth, open interest holds steady or expands. If open interest is stable despite the margin hike, it means traders are absorbing the cost increase. If open interest actually grows with price, that's genuinely bullish. It means new capital is entering the market at higher margin requirements, which signals conviction. Fifth, physical accumulation continues. If PSLV and other physical vehicles keep adding ounces, the structural floor strengthens. Paper volatility becomes noise above a rising physical bid. In this scenario, the margin hike is a speed bump, not a roadblock. Silver consolidates, absorbs, and then pushes toward the next major psychological levels, $95, then the big round number, $100. These levels will attract enormous attention, both from bulls celebrating and from bears looking for a reversal. The journey there would not be smooth, but the direction would be intact. Scenario B is the margin cascade. The tightening triggers a forced liquidation event. This scenario triggers if the following conditions develop. First, silver breaks below recent support levels, yesterday's lows and the weekly close, with conviction and volume. That break would trigger stop losses and activate margin calls among traders whose buffers were already thin from the margin hike. Second, open interest drops sharply alongside price. This is the definitive signature of long liquidation. When price falls and open interest contracts simultaneously, it means traders are closing positions, not adding new shorts. They're being forced out. Third, the dollar reverses higher. A DXY moving back above 97.5 and toward 98 or beyond would add macro pressure on top of the margin pressure. Silver would face selling from two directions simultaneously, leveraged longs unwinding and dollar strength compressing metals. Fourth, yields spike. If the 10-year pushes back above 4.25 or toward 4.35% on strong economic data, the opportunity cost argument intensifies. Capital flows out of non-yielding assets and back toward treasuries. Fifth, CME raises margins again. A second consecutive margin hike would be devastating for leveraged longs, who just barely survived the first one. Each additional dollar of required margin pushes more traders past their breaking point. It's cumulative pressure. And the second hike is always more dangerous than the first because the buffer has already been reduced. In this scenario, the liquidation cascade I described earlier plays out. Forced selling creates more selling. Air pockets form. Silver drops multiple percentage points in a single session, possibly in a single hour. The chart shows a long wick, a flash crash candle, and by the time most retail traders understand what happened, the move is already over. But, and I want to be very clear about this, even scenario B is not the end of the silver story. It's a positioning reset. The physical deficit doesn't disappear. PSLV doesn't liquidate its 217 million ounces. Industrial demand for solar panels and electronics doesn't evaporate. The structural case remains intact. What changes is the price level at which the next leg begins. And for patient capital, a margin-driven flush is an opportunity, not a catastrophe. It's only catastrophic if you're the one getting the margin call. And this brings me to the third cliffhanger, the one I want you to sit with. If margin hikes are the weapon the exchange uses to control speculative excess, and if those hikes can trigger cascading liquidation events that crash price temporarily, then who benefits from the crash? Who is on the other side of the forced selling? Who is buying when leveraged longs are being forced to sell at the worst possible price? Think about that, because the answer reveals something fundamental about how futures markets actually function and who they're designed to serve. I'll let you sit with that question. Now let me give you my watch list. Here are the 5 things I am tracking every single day to know which scenario is playing out. Number 1, CME margin announcements. This is the top priority right now. Not price, not the dollar. Margins. Because margins are the mechanism through which the exchange controls leverage in the market. Any additional hike from current levels dramatically increases the probability of scenario B. I check the CME margins page daily. You should too. Bookmark it. Make it part of your routine. Number 2, the 10-year Treasury yield. Direction is everything. A sustained drift below 4.10% tells me the macro headwind is fading. A spike above 4.25% tells me the headwind is intensifying. I use Fred DGS 10 for this. It's free, it's official, and it updates regularly. Number 3, the dollar index. Below 96 is bullish for silver. Above 98 is bearish. In between is noise. The dollar is the most important macro variable for metals after yields. Watch the daily close, not the intraday noise. Number 4, open interest changes in silver futures. This is the positioning signal that tells you whether the margin hike is being absorbed or whether it's triggering liquidation. Stable or rising open interest with stable or rising price means the market is healthy. Declining open interest with falling price means forced selling is underway. This data comes from the CFTC and from exchange reports. Check it weekly at minimum. Number 5, PSLV and physical inventory data. Watch ounces held in PSLV. Watch COMEX registered inventory. If physical accumulation continues despite futures volatility, the structural floor is intact. If physical vehicles start seeing outflows, that changes the equation. The physical bid is silver's foundation. As long as it holds, pullbacks are temporary. That's the checklist. 5 signals. No noise, no opinions, just mechanics. Let me bring this all together. Silver is in one of the most interesting and dangerous configurations I've seen. The price is surging. Momentum is powerful. Nearly $95, 7.5% rallies. Headlines everywhere. But underneath that surge, the exchange is tightening the screws. Margins are going up. The cost of leverage is increasing. And the traders who rode this rally with borrowed money are now sitting on positions with shrinking buffers and growing vulnerability. The dollar is helping. It's soft near 96.90, and that cushion is preventing the margin pressure from cascading. For now, yields are a headwind. At 4.18%, the opportunity cost of holding silver is real, not fatal, but real. Physical demand is the bedrock. 217 million ounces in PSLV alone, structural deficits, growing industrial consumption. This is the part of the silver story that doesn't care about margin hikes or futures volatility. It just accumulates. And the positioning is active but not extreme. 143,000 contracts of open interest with a net long speculative bias. Directional but not dangerously crowded, not yet. The tension between these forces is what creates the crossroads. Momentum versus margin pressure. Physical demand versus paper fragility. A soft dollar versus elevated yields. Something has to give. And when it does, the move will be fast. In either direction. If margin pressure triggers a cascade, the downside will be sharp, violent, and temporary. If the market absorbs the margin hikes and the dollar continues to weaken, the upside could be historic. Silver approaching triple digits for the first time would be a generational moment in precious metals. Either way, the traders who survive and thrive will be the ones who understand the plumbing. Not just the price. The plumbing, the margin mechanics, the positioning, the physical flows, the cross-asset context. That's what this channel is about. And that's why I spend this much time breaking it down for you. My stance is constructively bullish but near-term cautious. I respect the structural case. I lean bullish on physical demand and the supply deficit, but I respect the margin risk. I respect the mechanical fragility that exists when the exchange is actively tightening leverage conditions during a momentum rally. This is not the time for recklessness. This is the time for awareness. Know your exposure, know your margin, know your plan if the market moves against you, and know your plan if it moves in your favor, because upside volatility can be just as disorienting as downside volatility when you're not prepared for it. This is education only. Not financial advice? I am not telling you to buy or sell anything. I am showing you how the market works so you can make your own informed decisions. Always manage your own risk. Now I want to hear from you. 2 questions. Question 1. Binary choice. Do you think the CME margin hikes will trigger a silver flush before silver hits $100? Yes or no? Question 2. Pick one of 3. Which signal are you watching most closely right now? A. CME margin changes. B. The 10-year Treasury yield. C. COMEX physical inventory levels. Pick one and tell me why in the comments. I read every comment. Your answers directly shape what I cover next. This channel exists because of this community, and your engagement is what makes these deep dives possible. I'm James. Today is February 14th, 2026. Stay sharp, stay disciplined, understand the plumbing, and manage your risk. I'll see you in the next one.